All right, let's get started. Today, we're going to talk about unlocking opportunities with creative financing. My name is Len Vannicola. I work at Rate Philly, formerly Guaranteed Rate. We are the preferred lender of KW Packard. So, what is a Rate Philly portfolio loan? For creditworthy borrowers who don't meet traditional lending requirements, a non-QM loan can provide an additional path to homeownership. Rate Philly is pushing the envelope with investors to continue to offer more outside the box products to help more clients purchase real estate and help them close more loans. What's unique about this is we control the process. We're underwriting these files in-house. We do not broker them. There's no third-party underwriting. It's just me, your client, and the underwriter. Our average clear to close is an industry-leading 24 days on these portfolio products. For everybody listening, when it comes to these non-traditional mortgages, closing in 24 days is unbelievable, and we're not brokering them. A lot of our competitors are sending these out to wholesale companies. I mean, we are doing this in-house. It's all us, which is very unique. So here's some stats for portfolio loans. The volume of these non-traditional style loans is expected to reach $25 billion by the end of this year. This is going to allow you, as an agent, to tap into 16.2 million self-employed borrowers and 33 million small business owners. 26% of all purchase deals last year were investment loans. 47% of those transactions were investors owning between 3 and 9 properties. This market segment is poised for growth, driven by the demand for self-employed clients and real estate investors. So here's just some of the basics. We're going to talk about prime clients with unique circumstances, self-employed borrowers who can't go the traditional route, meaning Fannie, Freddie, FHA. You can be self-employed, but maybe they have a few, there's a little bit of hair on that deal, so we got to take it to a non-traditional route. Non-traditional income sources. That an example could be retirees who don't have any income, but they have substantial assets. Another one would be Uber drivers, real estate investors. A lot of these products have a 40-year term. You know, the extended amortization allows you to have more affordability. And then prepayment penalty options on investor loans that will reduce your interest rate and increase purchasing power. The stigma attached to prepayment penalty is very negative. Prior to the financial crisis in 2008, a lot of companies were incentivizing throwing basically BS prepays on a standard loan, and lenders were getting paid for that. This is the way prepayment penalties are supposed to work. If you're familiar with high finance, like commercial, you know, somebody's buying a 200-unit apartment building, a lot of that financing will have prepayment penalties. But basically it's saying, I'm not going to leave this property, sell it or pay it off in just say 24 months. And the lender's like, all right, well, because you're going to do that, your interest rate can be an eighth lower or a quarter lower. So it's worth it. So one of the first programs I want to talk about is the 1099 income program. And this is a program that should catch the eye of all the participants today. This is a program where, I mean, especially for real estate agents, most of you are 1099. So instead of requiring your full tax returns, a 1099 mortgage relies on the income you report to the IRS via Form 1099. This is a major advantage if you're self-employed and maximize your tax deductions because it allows you to meet your loan requirements with your full income instead of your deduction reduced taxable income. Most recent 1 or 2 years 1099 transcripts, we will verify your year-to-date earnings that are in line with the last 12 to 24 months. Employer contract or a CPA to confirm that you have no known job-related expenses. We will apply a 10% expense factor. What that is in the context of a non-QM loan, it means that when we verify your income for a borrower who is self-employed and primarily uses 1099, the lender will automatically deduct 10% of the gross income as a business expense. You need at least a 2-year history in the same line of work. What this is good for is someone who takes a lot of deductions on their 1099 income. This program will give them more income to use. You're an agent, your total income is 100 grand. You write off 30. We're going to give you credit for the 100. We're going to take 10% off, so we give you credit for 90. That additional 20,000 could be used to help you qualify for a property. It could be the difference between qualifying and not qualifying. Another program, asset utilization. We'll need 6 months of consecutive asset statements to verify a stable balance history. All parties on the account must be borrowers on the loan. Qualifying income. Qualifying assets are going to be divided by 84 months. Can be used by itself or combined with other sources of income. And here's an example. A couple is buying a luxury home in Society Hill. One of the parents quit their job a year ago to stay home with a newborn. With that income, they can't qualify to buy a home. The stay-at-home parent does have qualified assets to the tune of $500,000 in an account. We can use that $500K and treat it as an income source to help them qualify for a new property. So if you take $500,000 and you're going to divide it by 84, that's an additional $59.52 a month that we can use for the stay-at-home parent as income, which could be the difference between them buying a new home or not buying a new home. Yeah, on non-QM financing. I mean, I'm almost done, but I can go over it with you after. What's your name? Alex, nice to meet you. I'm Len. Next, we're going to go to bank statement income. Self-employed borrowers only. Borrower must own 25% or more of the business, and the business must have been in existence for at least 2 years. Personal or business bank statements must cover account activity for the most recent 12 or 24-month period. Statements show a trend of ending balances that are stable and increasing over time. Here are some examples. Checking, savings, money market, stocks, bonds, mutual funds. Yeah, that's okay. You can do the next one. Say it. Retirement assets, the vested balance is 80%. If it's an employer-sponsored plan, then you must provide terms of withdrawal to verify access regardless of employment status. Who's going to fit this program? A client whose tax returns do not fully reflect their revenue stream. Many self-employed borrowers are going to fall into this category. The next one we're going to talk about, which I'm sure most of you have heard of, it's getting pretty popular, is a DSCR, debt service coverage ratio. Only for investment properties, the DSCR equals the average gross income divided by the proposed PITIA. The gross rental income is the lower of the executed lease or market rent from the appraisal. So we'll actually have an appraiser go out and tell us what the market rent's going to be. The better the DSCR ratio, the better the property cash flows, which means the terms of the loan get more appealing. This is great for a client who wants to invest but may have qualifying issues under traditional terms. The burden of qualifying falls mostly on whether the property income carries the property debt. So I have a calculator here real quick. Borrower name, we got Saquon Barkley. He lives at Lincoln Financial Field. He's looking to buy a property. The first on the left, you have the first mortgage, $5,500 a month. Homeowners insurance is $200. Property taxes are $500. So the total mortgage is $6,200 a month. We get the market rate appraisal. The appraiser determines that the market rent could be $7,000 a month on this property, or $84,000 a year. You're going to take $7,000 divided by 6,200, and over on the right, in the yellow, you have a DSCR ratio of 1.12. We will not go below a 1. When you're below a 1, it's a negative. So that would be the mortgage is $7,100, and the rate and the market rent is 7,000. It's got to be at least equal or more. But again, this is a great way to get someone into an investment property who maybe don't show their income. You know, minimum credit scores is 660. This program is very flexible. Again, another program that's used a lot on the debt equity side. A lot of commercial realtors are going to be very familiar with this, but it's a great program. Another program we have that's kind of mind-blowing. If any of you have ever had an issue where you have a client that has a departing residence, let's say they own a house in South Philly, they want to buy a house in Grand Hospital, they do not qualify with both mortgages. The thing you're going to run into is, all right, well, we want to sell the house that they're living in, but we need to sell it before they buy a new house. So what this will allow you to do is we have a product that will allow a client who needs to exclude a departing resident's debt to purchase a new home. The departing residence must be on the market within 90 days of closing on a subject transaction. So it can be either listed or not listed. Equity in the departure residence must be documented with a 2055 exterior appraisal with full appraisal. Their equity position must be at least 20%. So let's say the house is worth $400,000. They can't owe more than $320. They can take that house that they owe $320 on, put it on the market, go buy another house in Grad Hospital. Let's say it's $500,000. They want to put 20% down. That's fine. We will exclude the debt on their current primary residence and allow them to buy a new home. I have run into this problem 500 times in the last 3 years. This product absolutely blew my mind. We've been closing a ton of them lately. It really is going to get people out of a jam, especially, with the clients who might be wanting to leave the city and they find their dream home in the suburbs. And, there's a time crunch. This is a product they can use. The rates are incredible. This is one that if I were an agent and would really want to learn more about, please reach out to me. I can answer any of your questions. I just want to say thank you from our team at Ray Philly and Go Birds. If any of the participants want to chat, just ask me some questions, or I'm going to put my email on here. The other thing I want to mention is this is kind of just scratching the surface of what we have as far as non-QM. These portfolio products, I would be here for 6 hours going all of them. I mean, we have probably 150 different products for every single scenario. Some of them are actually, you could be a first-time home buyer, or you're a seasoned investor. We have products for second homes, investment properties. It's kind of endless. I really wanted to just consolidate this today and go over some of the basics because it's absolutely impossible for me to go over everything. And honestly, it would just be confusing at that point. So shoot me an email. Let me know if you have any other questions or if you have any clients that you want to talk about real quick. But if you run into any of this in the future, please reach out. All right. I appreciate everybody coming on today. Have a great day. And I'll be honest with you, go Penn State. See ya.